If you're in crypto, you've probably been glued to the price charts. As of late November 2025, it's been a wild year. Bitcoin rocketed to an all time high over $126,000 in October before pulling back sharply. Right now, you might see Bitcoin trading around $90,000 and think the worst is over. You might be hearing the calls for a new bull run in 2026, but don't let the price chart fool you. Those violent swings we saw, where the market was hit by the largest single day liquidation event in history, weren't just a dip. They were a warning sign. Billions of dollars don't just vanish for no reason. The real danger in crypto right now isn't the price, it's the fragile plumbing underneath. It's a series of technical time bombs ticking away quietly that could vaporize your investment without warning. Today, we're going to find them and defuse them. We'll uncover the three hidden risks that most investors are completely ignoring, starting with the very force that caused those gut wrenching drops, the liquidity crisis. So that brings us to our first and maybe the most dangerous time bomb, the liquidity crisis. What is a liquidity crisis? Think of it like a swimming pool. A healthy market is a deep pool of buyers and sellers. You can jump in or out without making a huge splash. But an illiquid market is like a pool that's rapidly draining. A small move can create giant waves, and trying to get out is chaos. In crypto, this means there isn't enough cash or stablecoins ready to absorb a big wave of selling without the price crashing. We saw this happen in real time in 2025. During the sharp sell offs, the market suffered from what you could call a liquidity mirage. In calm times, everything looked deep and stable, but under stress, that liquidity vanished. We saw bid ask spreads, the gap between what buyers are willing to pay and sellers are willing to accept, widen like crazy. What looks like a deep market can instantly collapse, especially for smaller coins. This isn't a normal correction. This is the market's plumbing breaking down. But why is this happening? There are two big structural flaws. First, there's no safety net. In traditional finance, if a big bank is in trouble, a central bank can step in as the lender of last resort to stop a system wide collapse. Crypto has no Federal Reserve for Bitcoin. When the liquidity drains, it's a free for all. This means that during a panic, DeFi protocols can essentially freeze up as algorithms force liquidate collateral, overwhelming any chance of an orderly market. We saw this during the October 2025 crash, where cascading liquidations just steamrolled the market's ability to absorb them. The second, and maybe sneakier problem, is market fragmentation. Crypto liquidity isn't in one big pool. It's scattered across thousands of tiny separate puddles on hundreds of centralized and decentralized exchanges. This has been called the most fragmented market structure in financial history. Think about it. A token like USDC exists on dozens of different blockchains. Instead of one giant, efficient market, we have a maze of disconnected markets. This means even a popular token can have thin liquidity on any single platform. A large sell order on a smaller exchange can cause a localized price crash. That sudden drop triggers panic, which then spills over to other exchanges like a domino effect. This isn't just a theory. In October 2025, the market saw the largest single day liquidation event in its history, with over $19 billion wiped out. As prices fell due to macro fears, leverage traders got hit with margin calls, triggering a forced selling death spiral. Billions in leverage positions were liquidated, and during this event, order book depth for Bitcoin futures collapsed on some exchanges. So, what should you watch for? Don't just look at the price. Look at the order book depth on exchanges. Thin order books are a huge red flag. Second, monitor the bid-ask spread. If it starts widening, liquidity is drying up. Finally, watch the futures market. High open interest can signal that the market is over-leveraged and vulnerable to another liquidation cascade. This problem is fundamental. It means even if you pick the right coin, you can still get wiped out if the market's plumbing fails. And this brings us to the second closely related time bomb, the very nature of the new money flowing into crypto. The second time bomb is something many people celebrated as crypto's biggest win, the arrival of institutional money and spot Bitcoin ETFs. Now, almost 2 years after their approval in January 2024, we're seeing the dangerous side effects. On the surface, big money coming in sounds like the ultimate win, and in many ways, it is. The launch of ETFs by giants like BlackRock funneled massive capital into crypto and helped drive Bitcoin to its new all-time highs in 2025. But here's the hidden risk. This has fundamentally rewired the market. First, the ETFs themselves acted like a giant liquidity vacuum. Instead of capital flowing onto crypto native exchanges like Binance or Coinbase and deepening the order books, a huge chunk is now locked inside these ETF wrappers. So while the price went up, the actual on chain liquidity available to soften a crash was ironically reduced. And when the market turned down in late 2025, these same ETFs saw billions in outflows, adding massive selling pressure that didn't exist in previous cycles. Second, this institutional money is different. The story was that institutions are long term holders, but a lot of this new capital is extremely sensitive to macro conditions. In the high interest rate environment of 2025, non yielding assets like Bitcoin look a lot less attractive. Crypto is now so sensitive to this that it has become, as some analysts say, the fastest sensor for US macro risk. The sharp market correction in October and November was driven by a risk off mood in global markets. This wasn't a crypto specific problem. It was global capital fleeing anything speculative. And because crypto is now plugged into the mainstream, it got hammered. For a time, Bitcoin's correlation with the NASDAQ 100 even hit recent highs. Institutions also brought their favorite toy, leverage. Sophisticated, highly leveraged trading strategies are now common on regulated venues like the CME. In fact, the CME has at times overtaken Binance in Bitcoin futures open interest, showing just how much of the market is driven by these institutional products. It was these leveraged bets that fueled the record-breaking liquidation cascade in 2025. It's a complete paradigm shift. The old 4-year cycle driven by Bitcoin's halving might be giving way to a new cycle driven by global liquidity. A recent Signum poll did show that for the first time, portfolio diversification has overtaken short-term profit as the main driver for institutional investment, which suggests they are here for the long term. However, it means the rules have changed. The idea of Bitcoin as a totally uncorrelated hedge is being put to the test. In a major risk-off event, institutional money will flow out, and the ETF celebrated on the way up become a powerful engine for selling on the way down. Now, before we get to our final time bomb, if you're getting value from this breakdown and want analysis that actually goes beyond the price, make sure you hit subscribe and turn on notifications. And if you want the deeper data-driven insights I can't always fit into a YouTube video, make sure you join my free weekly market newsletter. The link is in the description. I break down the macro forces, liquidity signals, and Bitcoin flows I'm watching every single week. Plus, I'm currently building out my macro investing and trading classes, and newsletter subscribers will be the first to get early access when they launch. And tell me in the comments, what's the one crypto risk you think most investors are still overlooking? I read every single one. The third hidden time bomb is lurking at the very heart of the on-chain economy, the domino effect of decentralized finance, DeFi, and the risk from stablecoins. If the crypto market is a skyscraper, DeFi protocols are the load-bearing walls, and stablecoins are the foundation. In 2025, we've seen signs that both are under immense stress. Let's start with DeFi. Its promise is a new, open financial system, but the rapid growth has created a tangled web where one failure can cascade through the whole ecosystem. DeFi protocols are just code, and code can have bugs. Exploits have led to huge losses, with over $3.1 billion stolen in the first half of 2025 alone. For example, a major exploit on Balancer's V2 pools in November 2025 highlighted how vulnerable even established systems can be. But the bigger danger is systemic. Many DeFi protocols are interconnected. A lending platform might accept another protocol's token as collateral. If that collateral token suddenly crashes, it can trigger a chain reaction of liquidations across the system, creating a contagion effect. It's a house of cards, and a sudden gust of wind can bring it all down. And that brings us to the foundation of this house of cards, stablecoins. Stablecoins are the lifeblood of the crypto market. The idea is simple. One stablecoin equals $1. But keeping that peg isn't simple at all. A stablecoin's stability depends entirely on the quality of the reserves backing it. The ghost that haunts this conversation is the collapse of Terra UST in 2022. While the industry has mostly moved away from that flawed algorithmic model, the risk from asset-backed stablecoins is still very real. The key issue is transparency. For years, there's been intense debate over the reserves of major stablecoins like Tether, USDT. In a November 2025 reassessment, S&P Global Ratings downgraded its stability assessment for Tether to weak, its lowest score, citing an increase in higher risk assets in its reserve portfolio and opaque management. Why does this matter? Because even a small doubt about a major stablecoin's reserves could trigger a bank run. If everyone tried to cash out at once and the issuer couldn't pay, the peg would break. This would be a disastrous event for crypto. Trading would grind to a halt and DeFi protocols that depend on stablecoins would implode. The European Central Bank warned in November 2025 about the potential for stablecoins to pose financial stability risks, especially as they become more interconnected with traditional finance. A stablecoin run could force the issuer to fire sale its reserve assets, like US Treasuries, which could even spill over into traditional markets. This domino effect is the ultimate hidden risk. You might hold Bitcoin, which you think is secure, but if the DeFi platform where it's being used as collateral collapses, or if the stablecoin you trade with DPEG, your investment is still at extreme risk. So, where does this leave us at the end of 2025? The crypto market is in a tricky spot. While prices have recovered some, the underlying structure is arguably more fragile than ever. We've walked through the three technical time bombs every investor needs to watch. First, the constant threat of a liquidity crisis, made worse by a fragmented market. We saw in the 2025 sell-offs how fast liquidity can disappear, turning a dip into a crash. Second, the double-edged sword of institutional money. The arrival of ETFs has tied crypto's fate to global macro policy, making it incredibly sensitive to things like interest rates and central bank decisions. And third, the DeFi and stablecoin domino effect. The tangled web of DeFi and the market's reliance on a few dominant stablecoins create a systemic risk that could bring the whole on-chain economy down. What this all means is that the old rules no longer apply. Just watching the price in the 4-year halving cycle is a dangerously outdated strategy. The real story is happening in the market's plumbing. The era of easy gains is over. We are now in a much more complex, macro-driven market where understanding structural risk is a requirement for survival. This isn't a message of doom, but one of empowerment. By understanding these hidden risks, by watching order book depth, tracking ETF flows, and scrutinizing stablecoin reserves, you can go from being a passive price watcher to an informed market participant. The key takeaway is this: in 2025 and beyond, your success will depend less on predicting the price and more on understanding the fragile structure it's built on. If this analysis was helpful, subscribe to the channel for more content that prepares you for the future of digital assets. And check out this next video where we break down exactly what on-chain metrics to watch to spot a liquidity crisis before it happens. Stay safe, stay informed, and I'll see you in the next one.